Braden and I talked to you about when we're building these retirement income plans, a very important piece of that is your spending. And what we really do is we break spending down into a couple of different categories: your essential needs, your wants, and then your legacy money. Well, the essential is kind of keeping the lights on, paying the bills. How would you like the ability to have that covered, guaranteed, and not dealing with having to have that deal with any market fluctuations? Well, in today's episode, we're going to talk to you about exactly how to do that.
Yeah, we've been doing this series on annuities, and this is really our sixth one. And we've had a lot of folks telling us that they just love the idea because they hear about annuities, they read about annuities, and we really wanted to break it down into chunks that people could actually digest. And so that's what we've done. This one is actually the one where we're going to take you through what income riders, how they work, how you need to think about them so that it has it all in the right context. So we hope you enjoy this. And we've got one more that we're going to do after this for the seventh and final one. But I would like to just remind you, if you've not had a chance to do so, we do certainly appreciate you going on and giving us a 5-star rating, and particularly on iTunes, and also writing us a review. We have had many, many people that do this. It certainly does help and benefit us. We appreciate it. And so it's one of our asks that if you can do it, we'd certainly appreciate it. Also, if you're hearing some of the things that we're talking about and you're not a client of ours and you've got questions, you can do it if you're a client, but this is really for non-clients. Is you can go to our website, and if you go to pomwealth.net/blog, now on the blog page, there's things for everyone, but there's a place there where you can go and click on to the right-hand side, and it says 4 steps to secure your retirement. And that is really an introductory mini video series that Mercer and I recorded. It's 4 separate videos that really kind of walk you through all the different things you need to think about when it comes to getting ready for and living through retirement. So please go visit that if you'd like. And we don't ask for any money. It's completely free. And so if you'd like to get more information, please go ahead and do that. But before we get started, we got to do one quick thing because all financial advisors have to do it. We got one quick disclosure and we'll get started.
That's right. So, the information contained in this podcast is intended to provide general information only and not to be considered individualized advice. Different types of investments carry different types of risk. As always, please contact your financial professional for advice appropriate to your specific situation. Enjoy the show.
Well, we're certainly happy to have you with us today on our podcast, and we're continuing down this path of really understanding annuities. And we know we've had now quite a few series. We're in number 6 right now, but we really felt like it was necessary to break it down into small chunks because it just makes it easier to understand. And today we want to tackle this topic of income riders, because some annuities you can have them and then you don't have to have them. But the question is, why would you have them? So we want to break that down. So in order to get us started, Mercer is going to kind of take us back through a little bit of a review and work our way into income riders.
That's right. So like Braden said, we've had a few episodes kind of stair-stepping you into how the annuities work and what they're all about. So just a quick recap. The annuities that we're talking about are in the deferred annuity arena. So not the immediate annuity where you can give the insurance company a lump sum of money and then they'll give you an immediate payout on a monthly basis. We're not talking about immediate ones. So we're talking deferred. And really in the world of deferred, there's 2 major categories. You've got the fixed side and you've got the variable side. The variable side is also a section we're not talking about. In the variable world, you're investing in the stock market. So you purchase a variable annuity. Very likely you're going to be buying mutual funds within that annuity, and you have all of the risk of the market. So you can go up, you also can lose money in there. And every now and then people will talk about the fees involved in the variable annuity side, and they can be high. So we're staying away from that section as well. What we really like to talk about and utilize is the fixed annuity arena. And in the fixed arena, there's really 2 different types. There's the traditional, kind of like a CD at a bank. So you go into a traditional, you give the insurance company a lump sum of money, and they say, okay, for a period of time, whether it's 3, 5, 7, 10 years, whatever it is, we're going to give you a guaranteed rate, very much like a CD would at a bank. So they'll give you a guaranteed rate. You cannot lose any of this money, so it's principal protected and tax deferred. And then on the index side, so you've got the traditional side, the index side. On the index side, your interest is not fixed like it would be with the CD. It's more linked to an index, kind of like the S&P 500 or the NASDAQ, the Dow, and several other different ones out there. And then there's different ways that your index is credited, which we've gone through pretty heavily in a previous episode. But just like the traditional, you cannot lose your principal. So your principal is guaranteed, and it is also tax deferred. So just a quick recap on how the interest is credited in the index side. So we're only talking index going forward for the rest of this podcast. Basically, you've got a few different methods, but just to remind you, it's basically on an annual reset. So you can start, say you gave the insurance company the money in January of this year, and then you're on an annual reset period, which means you won't know what you have made until you get to January of next year. So annual point to point. A couple of different ways it could be. It could be your index has a cap of 5%. So let's say the index went up 7% in that calendar or in that contract year, and your cap is 5, so you earned 5%. Another different way of crediting is a participation. So maybe the index went up that 7% again, but your participation rate is 50%, so you made 3.5. So just a quick recap there. The biggest thing about the fixed index annuity, though, that we like a lot is the principal protection. And what I mean by that is, well, let's say that index didn't actually go up, but it went down, and it went down considerably. Say it went down 5, 10, 15, 20, 50%. Well, the deal you make with the insurance company is that you cannot lose money due to market volatility. So if the index falls, say 50% in your contract year, the worst you can do is earn 0. So the index goes down 50%, you actually make 0 for the year. And that's part of the huge power that comes with the fixed index annuity. Once again, it's not something that's out there to make you a ton of money in the sense of earning 10, 15, 20% returns like the stock market. It's really there to be more of a bond alternative type of investment. So it's good, safe accumulation. And so that kind of takes me into reasons as to why would you ever do a fixed index annuity? Why would you ever incorporate that into your plan? And so really, Radon and I believe that there's 3 major reasons. The first is kind of what I just went over. Good accumulation, safe accumulation. You're not worried about the risk of the market because the worst you can do is earn a 0, and hopefully you make a decent rate of return over the period. We typically like to say if it earns in that 3 to 5% window on average over, say, 10 years, it's doing its job. So think of a bond-like return without any of the risk of being in the bond market. Last year, we saw bonds fall just like the stock market did. So take out the risk of the bond market, have a decent rate of return. That's reason number 1 why you may want to consider a fixed index annuity. Another reason, and it's not a major reason, we see it every now and then, but pretty rarely, is for death benefit. So let's say you can't qualify for life insurance, but you really want to have a death benefit plan. And so maybe you can buy an annuity that is structured toward death benefit. So it's still going to have the same safe accumulation, but the umph that it brings to the table is that it may have a multiplier as to what gets paid out when you pass. Like I said, we don't use these that often, but it is a nice little tool there if you can't qualify for life insurance. And then another major reason, and what we're focusing today in today's podcast, is for guaranteed income. So kind of like a pension where you say, I want to have a certain amount of my income guaranteed. Because when we talk about guaranteed income, there's really only a few different places that you can go to get this. You've got Social Security. Some of us may or may not have a pension that's not fully guaranteed, but it's supposed to be pretty secure. But then if you're looking outside of that world, really, you've only got a few different places. One could be a place or an investment at a bank. And so you've got guarantees with the bank because it's backed by the government, but there's really no rate of return there. Treasury bonds, really no rate of return there. So when you're talking about guaranteed income, we find the fixed index annuity a pretty good place to do that. And the way that they do that is they attach what's called an income rider to the policy. So you've got the same thing, you've got the accumulation, but then you can also add on an income rider. And then that, in all essence, is going to be the way that creates your own personal private pension, guaranteed $1,000 a month for the rest of your life, or $1,500 or $500 a month for the rest of your life. So it can be very powerful for the right situation. So that's why we bring it up today. I'm going to let Radon take over and explain the what and kind of the why as to why we would ever attach an income rider to this vehicle.
All right. So as we go into this, again, we know we're going to be using some numbers, and so we'll try to take it and help you to visualize it. But, when you think about the income rider and what it's providing for you, it's really providing you peace of mind and security. It's the same reason why a person would take a pension or why they would like their Social Security, because they know that they have that income coming in and that it's guaranteed. Now, we will use income riders in a couple of different ways. One of those is a person knows that they're going to need a certain amount of income in a year. That's not as common as somebody's coming to us and we say, hey, we're going to make it so that there's income that will come on and turn on and give us income maybe in 5 to 10 years. So even if a person comes to us and they're 65 years of age and we're trying to plan income at 70 or 75 for an inflation hedge, we will use income riders in that category. Now, when you add an income rider to an annuity, in most cases, it is going to have a fee. There are a couple of annuities that they have built the rider into the annuity. Just understand that if they do that, the income rider may not be as rich or have as much guaranteed income if it doesn't have a fee, because they can't afford to give it to you. So just keep that in mind. But we want to understand how it works. And that's really, really, really important, because if you go talk to an agent who sells annuities and they talk to you and they say, hey, I've got an annuity that is going to give you a guaranteed 6 or 7% rate of return, know that that is not on your accumulation that you can walk away with. The income rider might grow at 6 or 7%, but the only way you can get value from that income rider is to take income. Now, that's not a negative. That's just understanding the right purpose of the income rider. So we want to make sure that we have guaranteed income. We want to make sure that we understand that it usually is a fee. It's usually around 1% if it's on a fixed annuity. And we want to understand how it works. So let's just think about it. And if in your mind, you could envision that there's this umbrella, that's the annuity. And then on one side of the annuity structure is your account value. That's how much money you put in and how it's accumulating. And then on the other side is this income value. So imagine that you put $100,000 into the annuity. That's what you invested. So that's your umbrella. And then one side, you've got this calculation that says, how much is it earning? So just for simple math, I'm going to say that that side is earning roughly, let's just say 3 or 4%. So it's going to grow as the indexes grow, like Merce talked about a little bit earlier, and as we've talked about in earlier podcast. But on the other side, if we've got an income rider, that income base may be growing at 6 or 7% a year. So why would we do it? Well, think about it for a second. If you put $100,000 in, 10 years later, let's just say that the account value on one side is growing at 3%. That means roughly we've got $130-some thousand in our account value. So in 10 years later, you've got $130,000 of account value. But on the income side, if you're earning 7% roughly, you have about $200,000. So on one side, you got 130. On the other side, you roughly got 200,000. So what's the difference? Well, let's just talk about it. If you were to die, what do your beneficiaries get? Well, they're going to get that account value, that 130,000, not the 200,000. What if you said, I want to take all my money out and walk away? What do you get? The 130,000, not the 200,000. But if you now decide I want income, they will base your income on the 200,000. There will be a percentage of that 200,000 that they will pay out. Now, again, these numbers all change. So I'm just giving you very hypothetical. Let's say that the payout is 6% of your account, of your income account. So if you've got 200,000, that means it's going to pay you $1,000 a month or $12,000 a year, guaranteed for the rest of your life. Now, here right now is where the importance of this income rider comes into play. Think about it. $12,000. If you did not have the income rider and you only had the 130,000, would represent nearly 10% of your account value coming out. And you would not do that if you didn't have the rider. Why? Because you say, if I take out 10% of my account value, I'm going to run out of money really quick. And that's the facts. That's true. But if I do it with this income rider and I take out that $12,000 a year, I am guaranteed to get that $12,000 even if my account value runs out. Because as I take out the $12,000, my account value will drop. But if it drops and it goes all the way to zero, the insurance company is guaranteeing me that they will pay me out the $12,000 a year for the rest of my life, no matter what. So it's really longevity insurance is what it is. So we just really, I think that's the key element here that I want to get you. I mean, there's obviously things here that you would need to see and understand and really understand those numbers. But the reality is you need to visualize that the account value and the income account value are two different things. One is kind of death benefit and walk away money. The other is really kind of annuity or pension-like income that you cannot outlive. Now, many people want that in their life. So, for example, we talk about this in other podcasts, but if I want guaranteed income on a portion of my income and I know I need that $1,000 and I don't want to have to worry, I don't want to have to think about it, I don't want it to fluctuate, then this is a really good plan. If I don't care about those things, not so big of a deal. Don't worry about it. So it's really, it fits a person's risk tolerance if you want to have all that. Our goal in all of our income planning is to make sure that we break income down into those three categories we always talk about. That's our essential income needs, our wants, and our legacy or giveaway money. And this, for us, in some of our planning, makes a lot of sense to make sure we put all that together and have some of this in this environment with an income rider. Now, we had a client of ours who's been listening to this series of annuities, and they said, man, we really like this. It just really helps us out a ton. They said, but we'd really like to hear how you implement it, how it looks in a plan, and how that would go. Because, they said, we know how we've been helped with this, but, I think it's hard for people to conceptually come up, how do you put this into an overall plan? So on our final annuity series of podcasts, which is going to be part 7, Merce and I are going to walk you through some scenarios of how we put this into action, how we put it into a part of an overall plan. And we'll share with you kind of like this hypothetical family that looks very much like a lot of the families that work with us, so you can understand how that would fit into the picture. Again, as we always say, if you have any questions or you ever want to get more information, feel free to go to our website, which is pomwealth.net. You will see multiple places there that you can request a 15-minute phone conversation. You can schedule it right on the website. We are glad to sit down and have a 15-minute phone conversation and answer any of your questions. But we certainly do appreciate you joining us today. We hope you find this beneficial. We'll talk to you soon.